Hey everybody, it's Seth and Paul for the Everything Money Channel. In this episode, we look at a stock you have never heard of. But if you're a follower of Joel Greenblatt and his book, The Little Book That Beats the Market, this is one that I bought this past July. It's gone up 43% in 3 months.
2 months.
2 months? That's right. Why has this happened? Paul and I look at the health of this stock, the free cash flow, the PE, all the numbers of a stock you've never heard of. And you might be maybe missing out on, Paul. Who knows?
Maybe.
Looks like it's got some potential. Right now on the Everything Money Channel. Let's do it. Paul, as you know, I put a bunch of money in the followings of Joel Greenblatt.
Yeah.
And the book, The Little Book That Beats the Market. I followed some of his advice in terms of investing in, what are the two factors he loves? I already forgot.
Return on assets.
Uh-huh.
And I think, what is the other one?
Regardless, is he basically...
Price to sales? No, it wasn't that.
He basically wants you to... He advises you on investing in companies that are growing rapidly.
Earnings yield. So it's like the reverse PE.
Yeah, great earnings, and no one's ever heard of them.
Not great earnings, just a low multiple of earnings.
Okay.
And a high return on assets.
So again, we always talk about stocks that are way overvalued. One of our last videos was on Carnival Cruise Line, which Paul is buying, a stock that's in the tank big time. But Paul thinks there's some positive things. So we're going to bring up this stock that no one in the world has ever heard of.
Can we talk about something else first?
Go ahead, Paul.
So you did July 1st. What is your return so far in your entire portfolio since July 1st?
I don't know if I could find that out quite quickly. Maybe I can. Yeah, so I think I can here. Total loss gain on 153,000 is about $3,000.
So 2%.
Yeah.
The market's up like 1 billion %. So you're currently suffering against the market. But here's the thing. The thing that he likes to do does worse during good times and better during bad times.
Mm-hmm. So I wanted to bring up, I said to Paul, let's talk about let's talk about a stock that no one's ever heard of. And the stock is Tivity.
It's also the best performing one you have.
This is the best performing stock I have, up 43% since July 1st. It is currently September 1st.
Yeah.
It's Tivity Health. I don't know what this is. I've never heard of it. I've invested about 5 or 6K into it. And Paul, let's do our 8 pillars of analyzing the health of a stock to see what's going on with this one and why it's doing so well.
So first off, this is a $750 million market cap company. So it's not huge.
Mm-hmm.
Nobody's ever heard of it. It's based in Tennessee.
Mm-hmm.
Are you from Nashville?
You talking to me?
Because you're the only 10 I see. Is that the joke? Is that the pickup line?
Here, look at that. Oh, look at
I'm getting the
Is that the pickup line?
I think so, Paul.
Thank you.
Go ahead.
You can also pick Memphis.
Are you? Got it.
All right. What's the first pillar, Uncle Seth?
Revenue growth over the past 5 years.
All right. 2015, 450, 501, 556, 606, 1.1.
Wow.
It's tripled almost.
Okay.
So a green check mark.
Cha-ching.
There.
How about number 2? Profit growth over the last 5 years.
Okay. Now this is a little bit different.
Why?
Look at this. Lost 31, lost 130, made 63, made 100, lost 286.
It's all over the place.
Yes, so this one would be a
Look at this big check. Boom.
red X.
Red X. Free cash flow growth. Net operating assets minus expenses. What is it?
Oh my God.
I know if you're listening in the car and Paul screams like that, we're sorry. Go ahead, Paul. What is it again? Free cash flow is what?
It is cash from operations.
Cash from operations.
So it's the business operations.
Yes. Minus expenses.
Less the capital expenses. That's the money invested back into their assets.
Oh, okay. Got it. I get it now.
So,
I still won't ever remember it, but go
exactly,
ahead.
You're
Free
terrible.
cash flow growth over the last 5 years.
So here it was 30 million.
Mm-hmm.
Here it was 30 million. Here it was 100 million. Here it was 100 million. And here, even though they lost money last year, was $58 million. So they've definitely increased. They had a couple big fluke years. So it'd be important to understand. But going back to the previous years, it was 28, 27, -8, 30, and 10. So again, last 5 years have been really good. It'd be important to understand why it was very good over the last 5 years versus the previous 5 years.
PE ratio is next for our fourth pillar. PE ratio less than 20. which is price to earning.
Well, remember, they lost money last year, so it's negative right now.
Okay.
So that's so even though it's less than 20, it's actually worse. It's bad. So we're going to go red X on that one.
Oh, no.
Yeah.
Total current assets greater than total current liabilities.
Okay, so we're going to go to the financial statement. We're going to go to the balance sheet. We're going to pick up their quarterly. So total current assets, that's the cash on hand essentially, 141 million. Total current liabilities, money they owe, 148 million. So it's
Even?
less.
Less.
141 versus 148. Now, let's go see previous years. Let's go to a random year here, a random quarter here, 226 versus 193. It seems like they're always in the negative. So this is a company that seems to always be in the negative. I want to understand for this industry why a health system like this is always in the negative on their current assets versus current liabilities. So that's still an X.
Pillar number 6 is price to free cash flow less than 15.
Okay, so last year they had, what was it? What was the free cash flow last year? Last quarter, last year? Last year it was?
Even, right?
No, $58 million in free cash flow.
Wow, 58
So
million.
what's 58 times 15, Seth? Because we want to have to, if we want the multiple to be
725 maybe?
no.
870.
870. So we want the market cap to be under 870 million. Do you remember what it was?
No.
Well, you have a really good attention span.
I'm sorry, what's your name again?
750. So green check there.
Oh,
We want to be under 870, and it's 750.
wow.
Yeah.
Okay. And the last one is decreasing share count.
Okay, so there we go to our trustee financial statement, income statement. These are all, so 10 years ago, 34, 34, 34, 34, 35, 35, 37, almost 40, 40, 46. So this is an X. I don't like this one as much.
So why did the little book that beats the market?
Because it doesn't care about anything. What he'd sit there and says is over the long haul, the best companies are the ones that have a high return on their assets and have the lowest multiple of their earnings. And this followed. This qualified. Now, I'm sure he looked at also the last 12 months of income statement as opposed to certain quarters. So he went to the last 12 months. Let's see what they did. Trailing 12 months. Oh, they still lost money in the trailing 12 months. So I don't know why it fell in there. But on this company, this company is not a no or yes for me. It's more of a, let me figure out why they lost so much money in the last quarter. Was there a big write-off? Was there something else that happened that caused them to lose a lot of money? Because they still had free cash flow. You saw that. There was still free cash flow. So they had something happen that had them have a big markdown and loss.
So this 43% gain over the past 3 months for me is a sign of what? I mean, can you...
Remember, in the short run, who knows?
Who knows?
But over a 10-year period, if this company were to keep growing and keep their share count steady, you're going to see big gains along the way. As long as they can keep all the metrics the same. They're still going to do well. But you're not going to own this company for 10 years.
That's right.
You don't know how long you're going to own it. You might own it for 1 year.
Mm-hmm.
And that's that. So in this company, Joel Greenblatt, he's trying to dumb it down to a system, right? Which is great. A lot of people criticize that. I don't necessarily criticize that. I believe in that to a certain level. Like, listen, just buy a package, a basket of stocks that fit a certain metric for you, and go follow them and keep doing it over and over. On an individual basis, am I buying this company right now? I'm not saying yes or no. I'm sitting there saying I got to understand why they lost so much money, why their cash flow increased so much and then plummeted.
Can you go back to just the general trend of the stock? I mean, maybe I have a huge gain because they were in the shitter.
Yeah, that's actually probably a big part of it.
And they're coming back?
So let's go to 3 months. Let's go to year to date, actually. So they're at $24, $25 a share. They fell all the way down to
look at that.
$3 a share. And now they're at 15.
Wow.
They were as low as $3 a share. They were a $150 million company just 6 months ago. 5.5 months ago.
Wow.
Isn't that incredible? Let's see their all-time high. Woo! Look at that, 2007. They were a $65 company.
They're still $15 right now?
And they're $15 right now.
Wow.
All right, so these things are, on the short run, you never know what happens. Tesla's example, Carnival Cruise Line's example, Love's example. Like, markets are never rational. They're never, it's funny, there's a thing called the efficient market theory that says all stocks sell for what they should because all information is known. That's not true. Information might be known, but it's analyzed differently. That's the qualitative art part of investing. Everybody's analyzing the same things different ways. These numbers are all the numbers, but how you analyze them is totally different. Like, I'm reading a book right now. I've been reading it for a while called Financial Shenanigans, like how you can look at a financial statement and see if there's lies. They can still put numbers on there that are there, but if you don't understand how that, like, immediately I sat there and said, well, why did they all of a sudden lose? Why did their cash flow skyrocket and then plummet?
Yeah.
That could be fraud. I don't know. It's probably not fraud, but these are the things that as you look at more and more, you have to understand.
Thanks for the insight.
No problem.
Follow the Everything Money channel, like and subscribe. Thanks, guys. See you.